Human nature, in the majority of cases, doesn't exactly favor risk-taking, and I know plenty of people who love the idea of taking risks and the potential upsides, but they never do. Hey guys, I'm Bret, and if that rings a bell, stay tuned because in this video, I'm going to be talking about the biggest problem that playing it safe can have on your finances. What's up guys? Now, in my younger, more naive days, I had this vision that by the time I was 30, I'd have made tons of cash and I'd be driving around in a Ferrari. I thought it was a sure thing, but at the same time, I knew nothing about finance. So I'm making this video as a 27-year-old for anyone in the same position as the younger me. Or in fact, anyone not within touching distance of retirement who doesn't already invest their money. And this could be because you either can't be bothered to or you just don't know where to start. Now, a recent survey of 2,000 people taken in America laid bare that those not already in a job that they're happy with, when asked what they wanted, said, number 1, a whole hour for their lunch break. Number 2, only a 2-mile commute. Number 3, less business travel. Number 4, 52 days off per year. And number 5, to be able to work from home more regularly. Now, these are not exactly the most aspiring, risk-taking things they could have asked for. I would have expected something more along the lines of to start my own business, or more time to realize this huge, amazing idea that I have. But apparently not. It seems that all that most people want is a longer lunch break to watch their latest series on Netflix, or a shorter commute so they can probably sleep in longer in the morning. And this withdrawn approach also spills over into a lot of other aspects of people's lives. Hey bro, wanna go on a road trip this weekend? Nah, I've got too much stuff to do at home. I think you know where I'm coming from, and another example would be to borrow some money to start a business. Now, a lot of people's reaction to that would be that there's no chance that it would work, that space is already so saturated, and you're better off just being an employee. And whilst that is perfectly respectable, don't get me wrong, in fact, stability does definitely have its advantages, think about the opportunity cost, the risk of playing it too safe. Especially when it comes to our finances, the biggest risk of all is probably not taking any risk. Now, to put all this into perspective for a second, let's talk about inflation. Over the last 10 years, global inflation has averaged around 3.4%. Make a note of this number because we're going to come back to it later. Now, you've almost definitely heard people talking about inflation, either on the news or somewhere else, but in case you don't know exactly what it is, and I remember back when I didn't know what inflation is the value of money over time. Take my house, for example. I recently bought a house, albeit one that needs a lot of work, but I bought one for around 250 grand. And during the conveyancing process, I saw that the previous owner had actually bought this same house for £10,000 back in 1978. And that rising value of my house is inflation. Now, you could argue that the previous owner potentially got it at a huge discount and maybe I've even paid a premium for it. But even if that was the case, there's still a huge amount of inflation there. Now, for example, say my house was my only investment. I lived in it for the next 20 years and I spent all of my disposable income on other luxuries. By the time I came to sell it, I'd be no better off than I am right now. And that's why, because the value of money decreases every year, it's really important to grow your money through other investments as well. So, what other investment options do we have? Let's take a look at the most popular investment avenues where most people in their 20s and 30s keep their money. Now, a very popular option is a fixed rate savings account or an ISA. Here, you're going to lock in your money for a period of time between maybe 1 or 5 years for a guaranteed rate of interest. However, the returns, the interest rate that you're going to receive on this account is typically between 0.3 and 1%. Another option that is possibly just as popular is a high-yielding savings account. Here you may have to jump through a few more hoops in order to be able to set up an account, such as already having an account with that bank or setting up your main current account with that bank as well. And a lot of the time there's going to be a maximum amount that you can deposit into that account per month, say £1,000 or $1,000 that you're going to earn that interest on. And typically you're going to earn between 1 and 3% interest on an account like this. And so it's still very low risk and the interest rates are still pretty low. Pension funds are another low-risk option. These are incredibly illiquid and can only be used for specific purposes. You can't just empty your pension fund next week and take out all your money. However, with most employers matching your contribution pension, it's basically like free money whilst you're employed and whilst your employer is also contributing. Now, if you remember the average rate of inflation that we spoke about earlier, you'll notice that at best, if you choose any of these investment options, you'll only be matching the historical rate of inflation. But more than likely, not even that. And this is a serious issue because you're merely keeping up with inflation. It's like being on a hamster wheel. You're working really hard, you're stashing away your money somewhere safe, but it's doing nothing for you. You're getting nowhere and your money is never really working for you. Okay, so I'm not saying that these super safe investment options are bad. In fact, you should always diversify your investment risk. So I would always keep an emergency fund of say 2 to 6 months worth of living expenses in an easily accessible account, but not more than that. Anything more than that and you're definitely losing out because there are better places that you can invest that money. And the problem is most people are not aware of this or just think that riskier, more complex investing is something for the super wealthy. But that is not the case. And if you really don't want to consider any riskier options, you can still build your wealth provided that you save a huge chunk of your income and spend extremely little money. But realistically, not enough people save enough money to make a noticeable difference this way, especially in a world where society and Instagram make lavish living look so within reach. I know, it can be really hard to be disciplined, to be frugal in your 20s and into your 30s. And therefore, if most of us don't take on at least some risk, it's going to be really unlikely that you're going to be able to retire at all, never mind early. In fact, and at best, the only thing that a 100% ultra-safe portfolio is going to do for you is maintain your current lifestyle into the future. So, where am I going with all this, right? Well, for all of the reasons that we've already looked at in this video, I would highly recommend that if you're in your 20s, 30s, or maybe even 40s, that you assign your savings, minus your emergency fund, an amount that you feel comfortable with, into riskier investments. Now, by this, I definitely don't mean buying a ton of penny stocks like Leonardo DiCaprio did in A Wolf of Wall Street and getting as high as a kite with your mates.
Steve Madden. Steve.
Okay, I'm of course kidding. That was just one of the most hilarious scenes in that whole movie, I thought. But seriously though, the more higher risk investments I'm talking about here are index funds like the S&P 500, real estate or property, and maybe even some individual stocks as well. And the sort of returns that you can expect on these investments based on historical figures for the S&P 500, which is an amazing index fund, would be 10% per year. For real estate or property rental, you're looking at about 5% per year, and that's not even including the appreciation of your asset, the actual property itself. And for stocks, the sky is the limit, because there are risky and riskier strategies within this category. For example, Google, which is a relatively low risk individual stock option, over the last 12 months, as I'm recording this video, would have returned you 28% on your investment. Whereas a stock like Zoom over the same period would have returned you 563%. But to have invested a substantial sum in a stock like Zoom 12 months ago would have been extremely risky. And yes, with these high risk strategies, prices are going to go up, they're going to go down, and at times you may even be losing money. But in the long run, talking 20, 30 years here, the market always goes up, and hell, if it doesn't, we're basically screwed anyway. You're young, you can afford to take calculated risks. Think about the things that you did as a kid that you wouldn't even dream of doing now. Maybe because you've got a family now, you've got people who are dependent on you, but because you were a teenager and you maybe had no dependents, you would take on much riskier things, like extreme sports, for example. It's like life insurance. Life insurance gets more and more expensive as you get older for a reason. And for that exact same reason, that's why millennials and Gen Z should invest. In your 20s, in your 30s, your job prospects and job stability is at its peak. Whatever ups and downs your investment portfolio throws at you, you'll be able to stomach it more easily because you still have huge potential to keep earning a salary. In comparison, once you get nearer to retirement age, you should consider a much less riskier approach to your money. This is because you're closing in on your retirement and you cannot afford huge shocks to your portfolio because after all, you're going to be needing that money in a few years. And that's why they, not you, are the ones who should be getting super safe. Now think about this. By not taking any risks at all and letting your money get eroded by certain inflation, you are actually doing the riskiest thing of all. Now just quickly though, if you have any debt, student loan debt or anything like that, especially high interest debt, consider paying that off first, unless you can find an investment that you're comfortable with that you feel will be able to earn you more money than paying off that loan. Any such investment should be one that you feel comfortable with, because it's all good saying that you're going to go into the stock market and you're going to make 10% returns and your student loan's only costing you 1%, whatever it may be. The stock market is no sure thing, and you actually could have lost all of that money and still got your debt, which actually would have even increased as well. That's it from me today, guys. Thanks for watching. I hope you enjoyed the video, and I hope that it got you thinking about the sort of level of investment risk that you want to take with your money. Please like the video, hit the subscribe button, and I'll see you next time.